Welcome everyone to this webinar. We'll get going now. And as I noted just prior, we will be recording. We are recording this for later distribution to our UU congregations, and we'll certainly use it with our UU Common Endowment Fund investing congregations as well. So thank you for being here. Randy and I have been very excited about giving this presentation, engaging you all on this topic. Hopefully, you see on the screen the front page for this presentation, which is also posted to the Whova app as well. If you want to download it, there actually are some links in that presentation that we'll talk about later that you might find useful. Um, we do have the closed caption turned on. We are recording this call as well. We welcome questions. Raise your hand or just jump in. We're a good sized group if you just want to jump in with a question. First, maybe some introductions. So I'm Mathew Jensen. I'm, as you can see on the page, Senior Investment Officer at the UUA, heading up our investment office. And I'm also assistant treasurer and trustee for my UU congregation here outside of Boston. I'm a middle-aged, white, curly hair, male, he, him, brown glasses on, a little bit of a gray beard, and a purple shirt. And I'm very, very happy that you're all here with us today. Randy, you want to introduce yourself?
Yeah, thank you, Matthew. Hello, everyone joining the call live, and for everyone who's listening in the future, thank you for participating. So yeah, my name is Randy Webb. I am in my late 50s, a white male, mostly bald, with a short cropped gray beard. I'm currently wearing a multicolored button-down shirt, and my pronouns are he, him. My background is blurred because I'm sitting in a very nondescript Marriott hotel room in downtown Baltimore right now.
Wonderful. Thank you, Randy. And Randy, to actually talk a little bit about your background too, just a quick second or two on your background, which
Oh
is
yeah, good point, Matthew. Thanks. So I'm currently a member of the UUA's Common Endowment Fund Investment Committee. I joined that committee a year ago. With my local congregation, I'm on the Finance Committee and the Endowment Committee. And then professionally, I worked in corporate finance virtually my whole career. And in particular in the area of cash management. That was an area of responsibility for much of my career.
thanks, Randy. So sustainable banking for congregations is something Randy and I have worked on personally and in our own engagement with our congregations. It's also something we've worked on professionally. I've certainly presented and done a lot of research on this topic just in my professional career as well. So Randy and I, when they were seeking topics for the General Assembly, Randy and I jumped on this and thought this was not only a great topic to talk about with congregations, but it's also a great time to talk about it, where given where rates are and where they've come from. So we're really happy that you're here, and why don't we jump in? Um, so we're broke this presentation down into two parts. The first part is really focusing on this concept of a sustainable bank for congregations. So what is a sustainable bank? Why does it even matter? And how do you find one? And what should you be thinking about when it comes to a sustainable bank? That's part one, and I'll cover that. Part two, Randy will cover, and he's going to look on what we're calling return on banking for congregations. And it's a new world for rates. For those of you who've looked at it, or maybe have not revisited it in a while, as my congregation was in the situation of, it's a whole different rate environment out there for savings and short-term investing. And if you haven't talked to your bank about it or looked at it in a while, there may be some returns there on the table for you. So we'll talk about strategies for cash management, and then Randy will take you through a case study with his congregation on how to approach this. And as I mentioned at the top, please, we're a small enough group. If you have a question, just unmute, jump right in. We'll keep an eye on the chat as well as we go through this. Okay, so let's jump into sustainable banking. And why are we even talking about sustainable banking? Well, sustainable banks have been getting a lot of attention lately, and I just put three headlines up on here. This is just from the last month or two or so. A pretty dramatic turnaround in the commitments banks had previously made to funding, um, uh, frankly, climate harmful activities. A lot of the banks have backed off of those commitments they made in the early 2020s or so, and pretty much opened the taps to funding a lot of carbon-based energy projects. Um, so the first headline here, and these are all linked in the presentation if you look at it. They talk a good game, but when you look behind at the numbers and their specific activity, and there was a great study that was just out last week that the UUA endorsed, this Banking on Climate Chaos study. 60 of the world banks have lent trillions of dollars to funding carbon-based energy projects around the world, and we only see that recently ramping now. The other dynamic that we see in banking is debanking. Banks not offering financial services to certain communities and even pulling out of certain communities. And I've got some pretty dramatic statistics on that later on. A lot of that goes back way back to redlining that occurred in the mortgage and insurance industries in the 40s, 50s, and 60s is still evident, and the residual effects of that today are still evident. The other dynamic that we've had in the banking sector is massive consolidation. You've probably worked with a bank that has since been bought and rolled up into another bank several times, and when they do that, they close branches in certain communities. So that debanking is a thing, and it really harms certain communities. So banking is an issue. And why should you care about it? So, for those of you, I know some of you know how a bank works. Some of you may not be familiar with actually how a bank works and why caring about who you're banking with actually has real impacts in the world. So, just a quick primer on values and banking and the flow of money. So, the basic model for banking is we as congregations or anybody with assets will deposit money in a bank, in a checking account or a savings account, because we want to use that money. We want to earn a little bit on that money, and we want that money available. We want it very liquid and available so we can use it when we need to, withdraw it when we need to, and then take advantage of some of the services that banks offer, ATM networks, checking, and other basic services that help us manage our cash. Well, when we put that money into a bank, they're doing two things with it. One is they're putting some of that into reserves that they're required to hold, and the other is they're lending that money out. They're turning around and loaning that money to somebody or some organization. So let's dig into this a little bit more. Turns out faiths in the US actually deposit quite a bit of money into banks. This was the latest survey from Giving USA. Charitable contributions to religions, just charitable contributions to religions was almost 146 billion, $1 billion. Much of that deposited into the bank. When you get a charitable contribution, some of that may be going to pay for expenses. Some of that is going to the bank. You may be putting some of that into the markets as well. But it's a pretty sizable sum that the banks get to work with that's coming from just the faith component in the US. And again, there's a link to the study if you want to see more information on it. The banks are taking that 146 billion roughly and typically putting about 10% of that into reserves. And that's required by law and regulation. It depends on the state the bank is in, the regulator they report to, the size of the bank. There's other dynamics there. But typically, that reserve amount, the amount that needs to be liquid and available to that bank for withdrawals is around 10% or so. And that frees them up to lend out the 90% of those deposits not held in reserves to other organizations. So the bank itself can generate some profit. So where's that 90% going? If we know that 10% is being held in reserves at the Federal Reserve or another organization, where's that 90% going? Well, it's often hard to tell where that 90% is going, but the Federal Reserve took a shot at it in one of their studies. And when they looked at U.S. bank lending activity, so this is the 90% that they're now lending out, you can see about half of that is going into real estate loans. About a quarter is going to commercial and industrial loans, and you can see the other types of loans, consumer loans, agricultural leases, etc. This is roughly the activity. So when you put $1 into the bank, 10 cents is going into reserve, 90 cents, 45 cents of that is going into real estate loans, and the other 45 cents are going into these other areas. That's your money that you deposited that the bank is in turn lending to these organizations. Uh, it's important to say this is not fully transparent. If you go to your bank and say, "Show me your loan portfolio," there's a good chance you won't be able to see it. Certainly, some of the public banks will have that information available. And as you'll see later, that's actually one of the notable distinctions with sustainable banks is they tend to be extremely transparent about how they're lending out your deposits. The challenge with this loan activity, as we saw earlier, is a lot of that certainly in the commercial and industrial space is going to fund, in this case, fossil fuel activities. And for us, for other organizations I've worked with, this sort of realization that in our fund, in our investment activities, we are fossil fuel free, but in our bank deposits, we actually may be funding fossil fuel projects depending on the bank that we're working with. And you can see here on this page some of the biggest funders of fossil fuel projects in the world: JP Morgan Chase, Citigroup, Bank of America, Wells Fargo in the US, and you can see some of the other banks here. We have a link to this report so you can see the full list of banks and their activity. UUA just endorsed this report. It was just released, I believe, 2 weeks ago. There was a great article in the Wall Street Journal on this report yesterday. If you subscribe to the Wall Street Journal, where they actually do a really good summary and dig into some of the dynamics there as well, but worth taking a look at. So some of our deposits are funding this activity when we may be fossil fuel free on the investment side. The other dynamic with banks, and I talked about it earlier, is debanking. And this is from a study from the FDIC, the Federal Deposit Insurance Corporation. That's the group, as you know, if you deposit money in the bank, the federal government uh, basically backs up that deposit up to $250,000. Well, that's the FDIC. The FDIC is the insurance that allows a bank to guarantee you that your deposits will be available up to $250,000. So the FDIC did a study. Again, it's linked here. And if you look at Black and Latinx households are only 32% of the population, but 64% of them do not have a bank account, and 47% of them use another product or service. And so many of you will be aware of payday lenders, check writing lenders, some very predatory lending activity that occurs in some of these communities where they don't have a bank, but you'll see a payday lender or check writing lender there in that community offering um, essentially banking-like services, but for exorbitant interest rates and exorbitant fees. They step in and take advantage of these communities. So this debanking, it's an ongoing issue. For those of you interested in this topic, Randy and I have just been talking about this book. It's just Randy, is that showing up with a blurred screen?
No.
It's not showing up. Is that better?
Oh, wait. Almost. Try again.
Yeah.
Nope.
No.
No.
No. Okay.
Yeah.
Well, I'll put a link in it. There's a great new book out called "The Bank's We Deserve. It's by Oscar Perriabello, and it goes through the really the whole history of the debanking trend, what's behind it, where are we today, and what institutions are trying to address this, frankly, crisis in banking services that's available in some of these communities. So there's a lot of issues with banks, and you may not know about it. It doesn't get a lot of attention, certainly not as much attention as the investing side. How you invest in uh, renewable energy and other activities. But your bank actually has a really meaningful impact. So your choice of a bank can have a big impact in the world. And so there's this whole category of banks. We're calling them sustainable banks. They actually go by many different names, as we show on this page, is green banks, socially responsible banks, ethical banks, social banks, alternative banks. Randy and I stuck with sustainable bank as the terminology, but they all basically refer to the same thing. And I will say for some of you, this may be brand new. You hadn't heard of these phrases or even this movement. And that's a dynamic, certainly in the US, but if you were in Europe, this is actually very active space. In fact, the largest sustainable bank in the world, Triodos Bank, is a Dutch bank that's active throughout Europe. So the concept of sustainable banking is not foreign at all in Europe. Some of the faith organizations I've worked with in prior careers use sustainable banks in Europe. But it's a relatively new concept in the US, but it's kind of an aggregation of some of the things that already exist here. So let's talk about what are the characteristics of a sustainable bank. So one characteristic is they tend to focus on this concept of what they call social profitability. So they want to see social and environmental value added from the loan activity that they're doing. They will avoid certain enterprises. So for example, if you go to Triodos, they're very transparent about, first of all, who they loan to and transparent about who they won't loan to. And when you look at their list of who they won't loan to, it frankly looks a lot like the investment restrictions on the Common Endowment Fund. They don't loan to weapons makers. Loan. They don't loan to oil extractors. Those types of restrictions in their loan portfolio. And here's our loan portfolio. They show you exactly what they're doing. Transparency is a big part of that. The banks seek to be economically viable but not money-making machines. So they want to temper this sort of urge to make as much money as possible and whatever loan activity they can get their hands on and try and be what they call viable. And they do that. They do offer competitive products and rates, as we'll talk about a little bit later, but they tend not to distribute large profits. And they tend to limit executive pay as well. Some of them actually have limits on the ratio of the compensation for the CEO to staff as part of the bank's operations. So economically viable is important to them. It gives them a little more flexibility too in where they can loan and where they do loan their portfolio. And then there's a whole faith specific element to this as well. And again, I see this more outside the US than inside the US. Um, there is the Vatican Bank, which does a lot of banking for Catholic institutions, can bank through the Vatican Bank. There's actually a couple of Catholic and Protestant banks in Germany that Catholic institutions and Protestant institutions can bank with, where the bank has uh, parameters around its loan activity that align with either the particular Protestant values, Lutheranism, say, or they align with Catholic values in the loan activity that they do. That's fairly common in some of these other countries. Don't see it again as much here in the US, sort of faith specific banks, but certainly this whole space of Islamic banking is massive. There's trillions of dollars in Islamic banking. And for those of you who know, Islam has very specific restrictions and requirements around the handling and use of money and around charging interest rates. And so there's a whole industry built around Islamic banking, both in the US and, of course, outside the US. So there are some faith specific banks. Again, not a dynamic we see much in the US, and I'm not sure why that is. Um, the services that these banks typically offer, they will offer the basic stuff. So deposits, loans, and checking. And again, they're taking those deposits, they're putting 10% into reserves, and they're loaning 90% of it out, and they're doing it in a way that's aligned with values that they've stated. Many of them don't offer treasury or cash management. If you're a larger organization that needs treasury services or some cash management services, unless the bank is particularly large, like a Triodos, you're probably not going to find that in these types of banks, and you're not going to find securities banking in this space. So, for us, for example, in the Common Endowment Fund, it's a large, sophisticated fund. We're doing private investing, global investing. We do need custody and brokerage and securities lending, and none of the sustainable banks offer these services. So you're in those cases you're forced to go with one of the larger banks. We use U.S. Bank for the Common Endowment Fund as an example.
Matthew,
Yeah,
one question's popped up in chat. And the question is, do you ever recommend credit unions?
yeah. Like we're gonna that's yes, we're gonna get to that in a second. Great question. Um, so most of these banks offer lax services beyond the basic. But for us as congregation, I know certainly my congregation, all we really need is the deposits, loans, and checking. And on the deposit side, we'd like to see some different availability in products. We'd like to see some CD offerings and other things. But we can typically, as a smaller congregation, we can typically get what we need from a sustainable bank given the services that they offer. Okay, so when I'll get to your question. We're going to talk about how you find one. Some of you may be wondering though at this point, like, well, wait a minute, these banks are smaller, aren't they riskier than the bigger banks? You know, I'm with Mr. Large Bank, and I know they have a credit rating and they have regulators, and it's going to be a safe place. And these banks sound like they're smaller. And so there's this claim that sustainable banks are riskier than what are called traditional banks, the ones that were on the list prior. And the studies we've looked at are really inconclusive. And in fact, one of the studies that we looked at recently says sustainable banks actually may be safer or less risky than traditional banks. And why? Because they tend to have simpler businesses. They tend to know their customers really, really well, and they tend to avoid controversial industries where you can have big swings in credit quality and such. So if you're thinking, well, I'm not going to touch this because it's riskier, no, that's probably not the case. All right. So how do you find one? And the question about credit unions, perfect. And I mentioned this earlier. This whole sort of moniker of sustainable banking as a roll up to these types of banks is really a way of combining some of the things that already exist. So certainly credit unions are in many cases considered sustainable banks. And I go back to how I defined a sustainable bank. You want to see those attributes in credit unions. And as the book I just talked about says, there are some very large credit unions out there that frankly act more like a large bank. So just because it's a credit union doesn't mean it's sustainable. It's a good chance it's sustainable, but it's not 100%, not 100%. Cooperative banks are typically owned by their customers. Again, a good place to shop. Doesn't guarantee they're going to be sustainable, but they're more likely to be sustainable. And then, of course, community development banks, really a whole category of bank that was actually, I think it was Bill Clinton in 1994 created the Community Development Bank Act, which led to the explosion of, in a good way, of these types of banks. CDFIs, some of you may know them as. It's actually a treasury project, and these are banks that are operating. We actually have a link here. These are that are operating, often operating in underbanked communities to offer banking services backed by the U.S. Treasury. And there's 1,400 of those in the U.S., so there's a lot of options there. Databases are a great source for this. So we have three databases on the screen: Mighty, Bank Green, and the CDFI Fund. These are all linked. So if you have the presentation, you can click through to Mighty, to Bank Green. You can go in there, type in, we're using Eastern Bank or we're using X Bank. You can see how that bank is rated. Is it considered a sustainable bank? Where is it leading or lagging on sustainable bank characteristics? And then you can see, well, what are some alternatives in my particular geography for my congregation that I could potentially consider. So these databases are relatively new in the last couple of years, very, very helpful as a research tool for identifying, understanding who your current bank is and then identifying maybe an alternative if you need it. That I just unloaded a lot on everybody. So let me pause there before we switch to the next topic. Any questions or comments or experience with sustainable banks? Any of this surprise you about sustainable banks?
Matthew, I'll echo a comment you made that that this is somewhat new information for a lot of folks. And I know for me personally, I've worked in the investment world my whole career, and I've learned a ton from you in developing this presentation over the last month or two. So I think for a lot of folks, this is all new information, and some of these resources will, I think, be very helpful to many.
Awesome. Great. Thanks, Randy. All right, let's shift gears a little bit, Randy. If you wanna jump in and now focus on the relationship you have with your current bank. And I'll move the slides. Just tell.
Real quick, Matthew, there's a couple of questions that have popped up here. One is,
Oh,
can we share the presentation by email?
oh, sure. Yeah.
Yeah.
In fact, maybe I'll see if I can post it in the chat while you're talking. It's certainly it's linked to the Whova page too. It's embedded in that, but I'll see if I can
Okay. Yeah.
attach it. Yeah.
And then the other question is, can you discuss the process of switching banks?
Yeah, big deal. Randy, you wanna
Yeah.
let's go through your example and then maybe touch on that one.
Yeah. 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 That is a good question,
Yeah.
and don't let us forget to come back to that one. I'm not an
Yeah.
expert on that, but we can discuss some of that. Um, So we're gonna shift gears a little bit here. The sustainable banking is gonna come up in this conversation, but the bulk of these next few slides focuses on return on banking with your cash that you currently have on deposit with a financial institution, most likely. Um, I will start by prefacing that I am not a certified financial planner or financial advisor. I don't hold any licenses along those lines. But as I said on the front end, I've worked virtually my entire career in this space, in the area of cash investing. In my prior job for most of my career. So I'm happy to have this opportunity to share some of what I've learned over those years with others, and hopefully some can benefit from this information, this knowledge that we're passing along here. Matt,
Yep.
Matthew, go ahead. Yep. So to think about the return on banking and investing cash deposits, uh, we'd be doing a disservice by not starting with the sort of the foundational piece, and that is short-term interest rates. Pretty much all of the products, all of the investment vehicles that we're going to discuss are tied to short-term interest rates, and short-term interest rates are very much tied to the Federal Reserve fund rate, which currently stands at just north of 4%. Um, and so this is important to think about in terms of the kind of the backdrop of where we've been over the last 15 or so years. And as you can see by the red circle on this slide, rates have been very historically low, very low levels, sub 2% for much of that time, but are currently hovering around 4%. Um, and as Matthew said on the front end, now is a great opportunity to be talking about this because there is a 4% opportunity um, to invest cash plus or minus 4%. And as you can see by the example, if you deposit $100,000 at 4%, you can earn $4,000 annually. Simple, pretty simple math. And so we're going to dive into this a little bit in terms of some of the products that are out there. Next page. Yep. So this term pick up nickels, I think about that in the context of hitting home runs as sort of the other end of the spectrum. And I've was trained my entire career to ignore the home run possibilities with cash investing and focus on picking up the nickels, not taking risk, but earning what's possible in the universe of investment opportunities with cash investing, not taking risk or taking very modest levels of risk. But most of what we're going to be talking about today is about not taking risk or minimizing that profile. And importantly, most organizations, most people, individuals, for-profit organizations, nonprofit organizations, and most individuals likely have at different points in time idle cash balances sitting in a bank account somewhere that could be earning interest. Looking back at that chart, if you think about it from 2009 to 2016, specifically, that was a 7-year stretch when interest rates were at 0%. And I know during my career at that point in time, our job was very difficult. We were basically earning zero, next to zero on the cash that we were managing for my company. And it was next to impossible to earn anything more than that without taking additional risk, which we weren't willing to do. But the problem is during that's a long stretch and an even longer time period when interest rates were sub 2%. So many folks lost that muscle memory of investing their cash, in the savings accounts or money market accounts or CDs, et cetera, because there was nothing to earn during that time period. But that has changed. In the last couple of years, the Federal Reserve has raised rates, and there is now an opportunity to earn more with our cash. And most importantly, from an organizational standpoint, and I'll touch on this later, this can help your budget to some extent. It's not a home run, but modestly can add a source of revenue, low risk revenue, to your operating budget. And again, I'll touch on that a little bit later. So this slide's got a lot of information, but in a nutshell, this is, there's an assortment of investment options out there um, for cash investors. And I've categorized FDIC, which products are FDIC insured, and which ones are or may not be FDIC insured. And so the first three, which are FDIC insured products, are going to be bank products. The bank that you're working with or the bank that you switch to work with likely will offer some assortment of these products. Maybe not all of them, but some of these. And the interest rates may vary, the fees may vary, the minimum balances, the number of transactions you can execute in and out of the account per month may vary. There may be certain restrictions. They're not all created equal, and they may be different from bank to bank. So you need to do some homework, a little bit of research. But all banks, virtually, sustainable and non-sustainable banks will offer some assortment of these products. What I've left off of this list are checking accounts. Your basic checking account, which is no interest, right? You're not earning anything typically on that checking account. And if you are earning something, it's probably a very minimal rate. So thinking about these first three categories, savings accounts are generally going to be lower interest rates. One of the articles that Matthew just mentioned, the Wall Street Journal Wall Street Journal article that just came out yesterday, I believe, says that the average savings account rate across banking institutions is about 0.5% currently. That's well below the 4% ish type rate that you can earn in some of these other accounts. Um, so moving up from there, you have money market accounts and you have high yield savings accounts. These are different types of higher yielding overnight deposit accounts that you can access potentially through your bank. These are typically going to be, according to the Wall Street Journal, somewhere around 3.5% to 4% currently, depending upon which bank you're working with and which product specifically. Again, you need to dig a little bit, do your little bit of homework. Do these accounts have a limited number of transactions? Historically, it used to be 6 transactions per month. Um, but those and that was a regulatory restriction. That regulatory restriction has been lifted, but some of these banks may still have restrictions on how many transactions you can execute. So you need to take that into account when you're thinking about which type of vehicle you want to invest in. The other product on the page here under FDIC insured is CDs, certificates of deposit. Many may be more familiar with that. CDs are effectively a term deposit. So these other vehicles are all I would consider investment within 24 hours from a money market account or a high yield savings account, assuming you haven't bumped up against any transaction limits. While CDs, you're committing to a longer term. You're basically locking up your deposit with your bank for some period of time in exchange for a fixed interest rate. Some CDs have a break feature where you can get access to your money prior to that maturity date, but many do not. So you need to think a lot about your liquidity requirements, your cash flow needs, et cetera, before locking up money in a CD. I see a question that's popped up regarding sweep accounts. That's a great question. So the concept of a sweep account is essentially, at least in the world that I'm familiar with, is where you have your primary bank account, your checking account, let's call it, where all of your operating transactions, your deposits, your disbursements are transacting in that account. But you're not earning anything on that account. You can link that account to, say, a money market account or a high yield savings account or a savings account, and transfer money back and forth, and earn interest on those other accounts. You can do that manually, or if your bank has the infrastructure to support it, a sweep account. And ideally, you have a bank that would allow you to somehow automate that. Automate that relationship between your checking account and I'll say savings account. I'm using that term broadly here because it could be a money market account, could be your high yield savings. But if you can set up a sweep account that would enable sort of hands-free transactions back and forth between your checking and your savings account, which is obviously much more attractive than having to move money manually. If you set that up, you typically are going to set up some sort of a threshold balance. So let's just say you might say, hey, anytime my checking account balance drops below $10,000, I want this sweep vehicle to automatically redeem money from my savings account to bring my checking account balance up to $10,000. Or likewise, if I just received a deposit of say $30,000 and my checking account balance is now say 40,000, then that sweep mechanism would transfer the $30,000 at the end of the day into your savings account, and you could start earning interest on it. And again, the important piece of this is ideally that sweep vehicle is set up in an automated way so you don't have to manually move that money back and forth. But not all banks are going to offer that. Maybe there's a fee associated with that feature, et cetera, et cetera. But it's certainly worth a conversation with your banker. I'll move on to the next category here. Same slide. Oops, sorry, Matthew. Let's go back to that slide real quick. So some other, and I would call these non-bank investment options. So this is where you'd be moving away from your banking partner, potentially having to open up a brokerage account. But there's government money market funds that you can invest in that are going to earn pretty competitive rates. Today, probably yielding in the high 3% range. I'm using government money market funds. There are also what we call prime money market funds, but prime money market funds typically invest the majority of their assets in um, corporate debt issuance. So you're taking on more credit risk there. Now, some would argue that investing in a money market fund that is predominantly investing in U.S. government-backed securities uh, in the current environment is also taking on credit risk. And I wouldn't necessarily argue with that. So, you know, as they say in investing, buyer beware. But generally speaking, a government money market fund is likely to be less risky from a credit risk perspective than a prime money market fund. Importantly, they're not FDIC insured, but those funds are directly investing the vast majority of their assets in U.S. government-backed securities. Um, and then the last one is a cash management account. Again, this is likely an arrangement you have with your brokerage firm, and also not FDIC insured, but likely offering a pretty competitive rate. Importantly, all of these products on this page are going to be tied to the short-term interest rates that are set by the Federal Reserve. And therefore, they're going to be floating rate vehicles, and they will change daily. The rates will change and fluctuate daily. The CDs are the sole exception. Once you invest in a CD, you've locked in that rate for that period of time. But if you want to buy a new CD a week from now or a month from now, the rates at that point in time will depend on where short-term interest rates are. So they will also move up and down, but not once you've locked them in. These other products, the rate is fluctuating daily. And hence, you need to keep an eye on that and understand the dynamic that's driving that fluctuation. The last point I'd make on this slide is talking to your local bank. Importantly, that's where you're going to get the most information. Pick up the phone, talk to your banking representative, and explore, what options are out there, and ask the questions. Well, what products do you have that are FDIC insured? What are the restrictions? What are the minimum balances or minimum investments? What are the fees, et cetera, et cetera. But have that dialogue with your bank, and try and get as much information as you can before proceeding. Okay, Matthew, next
Hey,
slide.
just a quick add there. Don't expect your bank to call you and say, "Hey, we've got a better product for you that pays a higher interest rate. You might want to consider." That is not something the bank will do. You really need to reach out to them and explore the products with them. That's from personal experience with our congregation. Um,
And Matthew, that's a great point. My case study that I'm going to be talking about, that's exactly what happened with us, and I
yeah.
will highlight that when we get there. Um, so another comment in the chat about laddering the CDs. Absolutely, absolutely, and I'll touch on that in our case study. Um, if you have cash, and this slide will touch on this, if you have cash that you're comfortable based on your sort of your risk analysis and your cash flow analysis, if you're comfortable locking it up for an extended period of time, and it could be 3 months, it could be 6 months or a year. Um, one way to minimize your risk is to invest in multiple CDs for multiple time periods. So create a laddered portfolio. So you could take a third of your money, put it into a 6 month CD, another third into a 1 year CD, and another third into an 18-month CD. And then importantly, leaving a sufficient balance in your savings account for immediate cash flow needs. But laddering CDs, once that ladder's created and time passes, then you can keep sort of rolling that ladder as the CD matures, and you can throw it out potentially to the far end of that ladder and maintain some duration, if you will, in the maturity profile of cash investments. So this table, attempting to sort of break out the different vehicles into time horizon and liquidity horizon. And time horizon is really kind of geared toward the investment horizon for the product itself, whereas liquidity or horizon is more geared toward the specific facts and circumstances for you as the investor or your organization as the investor. And as you think about your liquidity horizon, down below, these are some of the key considerations you need to think about. What's your risk tolerance? What's your cash? Do you have a cash reserve policy or philosophy at your institution? And then lastly, you think about cash flow modeling, cash flow forecasting. You need to have a pretty good handle on, okay, if I'm going to tie up some money in a 6 month CD, what's the probability that I might regret having done that 3 months from now or 4 months from now? So having some visibility into what your future cash flow needs are, both inflows and outflows, is very important as you contemplate these different investment products and these investment vehicles. But importantly, most of the products on our prior slide, the savings account, a money market account, the money market fund, the cash management account, even the high yield savings account are all generally overnight investments. The exception is that some of those accounts might have a limited number of transactions that you can execute on a monthly basis. So therefore, if you're getting close to the end of the month, if you've tapped out and you've hit the upper end of your limit, you may have to wait till the first of the next month to withdraw funds. But beyond that, these are all overnight vehicles. And then as we've already talked a lot about CDs. Obviously, those are longer term vehicles. And then beyond that, I'm not going to spend a lot of time on it. But if you have sufficient excess funds, you could consider, say, short-term bond mutual funds as an example. If you want to invest, say, sort of in the 1 to 5 year time horizon and earn potentially higher yields than what you're earning on your cash, assuming interest rates are higher for longer term investments. And then beyond that, then you're getting into, potentially 5 years and beyond, much more risky investment options, longer term bond funds and equity mutual funds, et cetera. But I would argue that very few institutions that have cash balances are considering ever investing in risky categories like that, even if they have sufficient excess cash. I think that argues for a much different conversation that moves away from sort of cash investing, if you will.
Yeah, that category is really you're talking about the organization's endowment assets and
Yeah.
such, which would
Yep.
could
Yep.
be invested in a common endowment fund or other long-term.
Yeah, exactly.
Got it.
Exactly.
Okay.
Yep.
Next page.
Right, next slide, Matthew. Yep. So the case study for us, I'm a member of the UU Society of Sacramento. I am now on the finance committee and the endowment committee, as I mentioned earlier. And so not in a too distant past did we have the bulk of our cash sitting in a checking account with our bank. Um, and as Matthew said, the bank wasn't knocking on our door. We were earning zero interest on that cash. The bank was not knocking on our door, offering higher yielding products, suggesting we move the money to here or there or something else. Um, and so I'll come back to who the bank is. But it wasn't until our treasurer started to attempt to transfer that cash out of the bank, did we get a call from our banker. And then they offered a product with an attractive yield, but only then when the cash started to move. Um, so the bank that we are banking with is a Northern California regional bank called Five Star Bank. I don't know. I'm a relatively new member of the society. I don't know the history, how long we've been investing with Five Star Bank. But looking at some of the resources Mathew provided earlier, they do reinvest significantly in the local community. As you can see, almost 80% of the deposits are returned in the form of loans to local communities. That's more than double the industry average. Where they fall short appears to be, according to Bank.Green, on climate responsibility. I don't have, it's tough to dig deeper into what that means, why are they falling short, et cetera. But it does, it does put this on the list of items to do for us to take a closer look at Five Star Bank and maybe consider shopping for a different bank. And this comes back to the comment on the chat earlier about switching banks. I'll talk about that in a few minutes. So, like I said, in the not too distant past, we started to lift the hood and take a look and say, hey, what can we do differently? We have some money that's arguably burning a hole in our pocket. We're not earning anything on our cash. So our finance committee executed an asset reallocation. As I mentioned, the treasurer started to attempt to transfer, and then our banker called. This was about a year plus ago. And they offered at that time a money market account yielding 4.75%, which was pretty attractive. So we took advantage of that and ended up depositing a significant amount of the checking account balance into that account. And then we said, well, if we put it all in an overnight vehicle like that, we're going to be subject to whatever the Federal Reserve decides to do with short-term interest rates, and our interest income will fluctuate as the Federal Reserve, raises or lowers rates, and we didn't want to be completely exposed to overnight interest rates, so we decided to essentially build a CD ladder. We at the time we invested in two CDs. I believe one was 9 months and one was either 12 or 15 months. And to basically lock in some of the current interest rate environment and remove some of that overnight volatility. The other thing we did was we did have some legacy investments in a Schwab investment account, a much, much smaller proportion of the total cash. I don't even know all the history behind that, but we did take some of that risk off the table as well. And the last important piece here is that when we looked at, okay, well, how much can we move into CDs and how comfortable are we, moving a bunch of money into the money market account? We ultimately concluded, let's try to leave, about 1 to 2 months worth of operating expenses in our checking account just to minimize the transfers. We don't have a sweep account with this bank. We haven't had that conversation yet, but I would be surprised to find out that they could offer an automated sweep feature. So our very thin finance team is now, has to monitor the balance in the checking account and periodically transfer money to or from that checking account and back and forth between the money market account to make sure we don't overdraft the checking account and also make sure we don't have a significant amount of cash in the checking account earning nothing. Um, so it's a manual process. And therefore, I would argue we're probably keeping more liquidity in that checking account than necessary. But in some ways, it's to minimize the amount of work that it would take to move money back and forth. Next slide, Matthew. Yeah. So this slide kind of depicts sort of the before and after we undertook that asset allocation change. And as you can see, almost 80% of the cash that we're talking about here that was sort of under review, almost 80% of that before we made any changes was in a non-interest bearing checking account. After we made these changes, that has dropped all the way to about 10%. And then, as you can see, the bulk of the cash is in an interest-bearing account, which is that money market account. And then in the 3 to 1 year period, about 13% currently is in CDs. And then the Schwab, the 5+ years piece is that Schwab investment. We still have some money there, but what we did was we reduced the amount of equity exposure we had there. And again, arguably that money we should be thinking about very differently and potentially looking at that. It should be a completely different conversation, frankly, than investing in our cash. So that's on our to-do list. As you can see in the little footnote there, our interest income is expected to increase significantly. It was virtually at zero just 2 years ago, and this year we're on a path to generate almost $40,000 worth of interest income from the investment decisions we implemented last year. Next steps for us to really kick the tires on sustainable banking options. Is Five Star the best local banking option we have, or are there some better options? And importantly, to the chat question, if we find a better option, that's going to involve some work. It's going to involve some paperwork to ramp up the new banking relationship. It's going to involve several conversations to make sure we understand what their capabilities are, what kind of products they offer, what kind of investment products, do they have a sweep vehicle, et cetera, et cetera. And then it's all the documentation that comes along with that. And then likewise, we're going to have to have that conversation with Five Star to let them know that we're going to be winding down the relationship. And maybe we won't wind it down completely, but maybe we would shift a significant portion of the assets to that new banking partner. There's no way around it. That's a project. There's work involved with that. Another to-do on our list is to consider shifting more of the money we have in the money market account into CDs to sort of build up that CD ladder. Again, to lock in rates. I think the current expectation is that the Fed is more likely to lower rates in the near future than raise rates. So consequently, the yield on that money market account would drop, and hence our interest income would drop. So locking in some additional funds with CDs, if we're comfortable with our liquidity profile, is something that we will certainly take under discussion and think about. And then last but not least is really that long-term piece, that 10% that fits into a long-term horizon. We should be doing something different than that. The common endowment fund is certainly a logical option to consider, given that our endowment fund is invested in the common endowment fund. And so that's going to be on our to-do list as well. I think I'll wrap it up there, Matthew. I don't know if you want to close with this last slide. Yeah.
Yeah, just Randy, that was great, and I will say, but very almost identical situation and outcomes with the congregate with my congregation as well. With some without taking on really any additional risk, we're picking up a lot of extra income that is very valuable to us. So some questions for you. Who is your bank? What are they doing with their deposits? What are your options at your current bank, and how should your cash be invested? These are some of the basic questions that I know Randy and his finance investment committee went through. Same questions my investment committee went through. We ended up consolidating a couple of different banking relationships with one bank because the answer to the first question was three different banks. Well, why do we have three different banks? What's the history there and such? So explore this, ask some questions and get involved. I think we'll stop it there. Randy, anything else you'd add?
Yeah, I just want to say, for folks on the call now or folks listening in sometime in the future, um, don't hesitate to reach out. I'm happy to be a resource. Like I said, I'm not licensed, I'm not certified in any way, stretch, or form, but I do have a decent amount of experience in this area, and I'd love to be a resource and help out as folks, go down this path and navigate some of these decisions and evaluate different ways to proceed. So don't hesitate to reach out. And I guess Matthew, how do folks get in touch with us? I know our names.
I was
Yeah.
just going to say we're pretty easy to get a hold of because we're both associated with the Common Endowment Fund.
Okay.
If
Yeah.
you
Good
go to
point.
uucef.org, you'll see our bios in there and links and emails and such. So yeah, pretty easy to find through that. And as I promised, I will if you can drop your email in the chat, just because I don't know if the Hoova app has everybody's emails. I'll send this presentation around to everybody. I'll certainly try and do it through the Hoova app as well. Any other comments or questions from folks before we wrap up?
Matthew, I'm just typing in my email right now into the chat just
Oh,
to
okay, good.
yeah, yeah.
Yeah, good question on the recording. I think it'll be hosted in the Hoova app, but Randy and I were talking earlier. We're definitely going to be pushing it out just ourselves through the Common Endowment Fund to everybody. We'll post it on our website, do a summary there, and make that available to everybody. But I believe the UUA will be pushing it out through the Hoova app.
So Matthew, a plug for the Common Endowment Fund. So we're launching a new website, enhanced, more user-friendly website.
Yes,
I think
yes.
on July, hopefully July 1st, right?
Yep.
So this presentation will hopefully be easier to find um, once that website launches in just 2 weeks. So
Yeah, that's right. Yeah, if you go to uucef.org right now, you'll see a website that looks like it was designed in 1998, maybe, and and it's very hard to find stuff on there. So yeah, we're about to launch a brand new website in a couple of weeks, and it'll be much easier to find this stuff. But uucef.org is where you'll find this, and like I said, we'll have a new website launched in a couple of weeks, and we hope to get this put up there. Same address, yeah. It will be just a relaunch of uucef.org. Totally new design, a lot of more multimedia stuff, this recording and other information there. Um, nice, nice, some really nice notes in the chat. I'm glad we were helpful. Um, thank you, Brian. Great. Okay, so we'll wrap it up here. I hope everyone enjoys the yeah, sold the
oh
building.
wow.
Some big decisions, yes.
Yeah. Peter, don't hesitate to reach out
Yeah.
as you're navigating that. We're happy to be a resource and chip in along the way because you know that's uncharted territory for many organizations to have a
Yep.
lump sum of money like that. Yeah.
Yep. Yeah, big one. Um, great. Thank you all for joining and asking phenomenal questions. I hope you enjoy the rest of the GA and you have some other really interesting sessions that you're going to. I know Randy's there. You might have a chance to bump into him. Although I hear it's very crowded, very busy. But Randy will be there
Yep.
in person. So thank you all. Have a great rest of your day.